The great rotation is when everybody goes, oh, sell bonds, buy stocks.
Right. Exactly.
It hasn't happened. Why?
It hasn't happened.
Why?
Well, I think because rates haven't meaningfully risen. I mean, the only time you actually saw a rotation out of fixed income into equities was during the taper tantrum, which is the only time that I can remember post-credit crisis that rates actually did something.
Let's make it up and make it simple. Rates up. Prices down. I'm losing money in bonds. I got to go to stocks.
You are a quant.
When will this occur?
So, I mean, you know, making the rates call is a tough one, but I think the point is that we're still at a point where your average individual investor, I think, is still over allocated to fixed income and under allocated to equities. So, if you look at flows into fixed income and equities, money has flown much more kind of freely and much more violently into bonds than it has into equities. We've only seen this sort of nascent bid on stocks. And, you know, what's even more interesting to me is that what investors are buying in the stock market are the most bond-like stocks they can find. Right. So they're buying utilities and REITs and, you know, anything with a yield, whereas your average stock-like stock, like your tech companies or your industrials, haven't really caught a bid.
Yeah, that's fixed income equivalent Tesla.
Savita, is it possible to describe...
and Tesla and high-growth stocks, that's right, yeah.
But is it possible to describe these as not normal times in the sense that the rotation already happened? The rotation went into really risky debt. Nigeria, Brazil, all this high-yield stuff. Is that what's going on?
Well, here's the thing. If that's the case, then there's even more money that's likely to flow out of risky, debt that's poised to not do particularly well once we start to see a move in rates into equities, which are a much better rate hedge. Okay. I mean, our bullish call on stocks is really the idea that where else can you actually get growing income? You can't get it from...
Savita, the reason everybody's piling into fixed income is because they're assuming that we are at the front end of a rate hike cycle, and that's the place to be. When rates tighten up, you want to be in fixed income.
Well, I mean, I think we should wait until they've actually tightened, because you don't want to be there along the way as rates are rising, because that puts some
but the hard, and let's go to your your quantitative analysis here. The great call is that dividend growth and share buybacks will end. You're suggesting it will not end?
Well, I think share buybacks are starting to and should end because stocks are a lot more expensive. And here's where Shiller is right, is that, you know, the market has re-rated meaningfully and it no longer looks as cheap as it did a couple of years ago. So all these companies that were buying back stocks at depressed valuations, that was smart. But now they're buying back stocks at fuller valuations, maybe not so smart. The thing that I think is kind of surprising is that the payout ratio for the S&P, the amount of earnings that companies are paying as a dividend is at almost a century low.
Can we get, Lauren, a Savita and Shiller hour?
I'd love that.
Would that be Shiller?
I would love that. I don't know if he would.